Hello everyone, welcome to a product review at Phenomenal. Today we are going to compare equal weighted index versus market cap weighted index. So let's start out with the performance chart. So we have taken Nifty 50 market cap weighted index and Nifty 100 equal weighted index. As you can see, Nifty 100 equal weighted index has done tremendously well since 2003. That's like a 23 years of history that we are talking about. So since the inception of both these funds, right, since 2003, this equal weighted 100, equal weighted Nifty 100 has outperformed the Nifty 50 market cap weighted almost in every year you can see. And recently, especially in 2023, it has even gone higher and higher because of the small cap exposure that you can attribute the returns to. If you look at the annual returns itself, right? In some years, Nifty 100 equal weighted has done well compared to the Nifty 50, where in other years, it's the same, vice versa, where Nifty 50 market cap weighted index has done well. So if you take, let's say, 2003, there's a big difference here, right? Almost 20% difference here. Let's take 2010 here. Nifty 50 market cap weighted index has done well. So this is like goes on and on. So during momentum markets where top 10 or top 20 stocks are driving the performance of the entire index, you expect the market cap weighted index to do better than the equal weighted index. Uh, that's what we are seeing in the US market, right? Currently, the market cap weighted index, that is the top tech companies, are driving the performance of the entire index. So you can see in the last few years, the equal weighted index might not have done relatively better than the market cap weighted index. But if you go again, take long history from 2000, compare equal weighted S&P 500 versus market cap weighted S&P 500, even in the US market, uh, equal weighted has done extremely well in terms of annual returns and also the performance. Now that we talked about the performance, let's go into the benefits. What are the other advantages of choosing an equal weighted index? One benefit is lowering the sectoral exposures compared to the market cap weighted index. So the two most heavy sectors in the market cap weighted index are the financial sector and the information technology sector. So as you can see, by choosing equal weighted index, you are automatically reducing the exposure to the highly exposed sector in the market cap weighted index. So here it's the big difference here of like almost 11%. Again, you have an 8% difference here. But that doesn't mean that your sectoral exposures are always lower compared to Nifty 50 market cap weighted index. So, for example, if you take utilities, right, there's a big difference here, but there's not like gigantic no difference here of like 20% or 30%. Now that we understood the sectoral benefits of choosing an equal weighted index, now let's go into the statistics of how well in terms of annual returns it has done. This is a big difference of like what 1.4, 1.6% here. 1.6% over 23 years, that compounds, the final amount would be crazy, right? So that's what we are seeing here. That's also what we saw in the performance chart as well, right? There's a big difference like in terms of KGAP itself, right? When it comes to volatility, it kind of surprised me. I was expecting Nifty 100 equal weighted to be much more volatile because you also have no small cap stocks and you are equally weighting all the companies, right? I was expecting it to be more volatile, but in terms of volatility, there isn't bigger difference. Same for Sharpe ratio. I wouldn't say there's a there's a massive difference. Yes, in terms of Sharpe ratio, again, Nifty 100 equal weight index is better because of the high KGAP, right? That's what bringing up the KGAP to 0.69 Sharpe ratio. Now, going into a few other benefits of equal weighted index. So we already know that Nifty 100 has 100, right? 100 stocks in it, so you're inherently diversifying your exposures, and that too you're equally weighting, right? So you're giving 1% to each and every stock compared to Nifty 50, where only the top 10 stocks, so here, only the top 10 stocks accounts to a larger percentage. So to prove that, the first column is the Nifty 50 market cap weighted, second one is the equal weighted, right? You can see 60% of the allocation in the Nifty 50 market cap weighted index is allocated to the top 10 stocks. That's a massive exposure just to the top 10 stocks, right? Compared to 10%, right? So in terms of concentration of like your stocks itself, it's automatically reduced by what, 50% here. That's another benefit of equal weighted index. I think that brings us to the end of the video. The main takeaway here is equal weighted index in terms of performance. It has done much better in India, right? As well as across different markets. So you can see the same evidence in the US market. You can also see the same evidence in the Australian market and few other markets as well. So in terms of just performance and annual returns, right, it has done well. On top of that, you should not be taking a chance at Nifty 100 equal weight index just for the performance or returns, right? There are also other benefits. You have sector benefits there, where your sectoral exposures comes down compared to the Nifty 50 market cap weighted index. The concentration to top 10 stocks massively comes down by 50%, as we saw a few minutes back. And also equal weighted index, you can capture the mean reversion effect as well, right? So basically, you're rebalancing the portfolio to 1% every month or every quarter, whereas Nifty 50, it's based on the market cap weighted index, right? So the top 10 or top 20 stocks will always have the higher allocation, and it goes higher and higher the more one stock or few stocks gets traded more. So you also, again, going back to the concentration risk as well. So that sums up the video. Thanks a lot for watching. See you next time.